Dividend investing is one of the most popular and reliable strategies for generating steady income and building wealth over the long term. It involves buying shares of companies that pay regular dividends to their shareholders, offering a tangible return on investment in addition to potential stock price appreciation. However, not all dividend-paying companies are equal. While some provide sustainable and growing dividends, others may falter, leading to reduced payouts or significant capital loss. Therefore, selecting the right dividend company requires careful evaluation of financial metrics, growth potential, industry stability, and corporate governance. This essay provides an in-depth guide on how to properly identify high-quality dividend-paying companies and avoid common pitfalls, enabling investors to build a resilient portfolio. Dividend-paying stocks are an attractive investment option for various reasons. First, they provide a reliable income stream, making them a favorite among retirees and income-focused investors. Unlike growth stocks, which rely solely on capital appreciation, dividend stocks offer tangible returns in the form of regular payments, which can be reinvested for compounding gains or used to cover expenses. Second, dividend stocks often belong to mature and financially stable companies, which makes them less volatile than growth stocks. These companies are typically well established with predictable cash flows and a proven track record of profitability. Investing in dividend-paying companies can also serve as a hedge against inflation. Companies that regularly increase their dividend payouts can help preserve investors' purchasing power over time. However, the benefits of dividend investing come with risks. Selecting the wrong companies can lead to income instability, as dividends are not guaranteed. Poorly chosen investments may result in dividend cuts or suspensions, diminishing the income stream and eroding portfolio value. Consequently, a disciplined and informed approach is essential when choosing dividend-paying companies. When selecting dividend-paying companies, a thorough understanding of key financial metrics is crucial. These indicators help investors assess whether a company's dividend payments are sustainable, whether the company can continue to grow its payouts, and whether its valuation justifies the investment. The dividend yield is a fundamental metric that indicates the annual dividend payout as a percentage of the stock price. It is calculated using the formula dividend yield is equal to annual dividend per share divided by stock price per share times 100. Dividend yield serves as an initial measure of a stock's income potential. A high yield may seem appealing, but it can also signal underlying issues. For instance, a company with a declining stock price may exhibit an artificially high yield, masking financial instability. Conversely, a low yield might indicate a company that prioritizes reinvestment over dividend payments. Ideal dividend yields typically fall within the range of 2% to 5%. These yields strike a balance between providing meaningful income and maintaining sustainability. Extremely high yields above 8% or 10% warrant caution, as they may indicate a risk of dividend cuts. The payout ratio measures the proportion of a company's earnings paid out as dividends. It is calculated using the formula payout ratio is equal to dividend per share divided by earnings per share times 100. A reasonable payout ratio, generally between 30% and 60%, ensures that the company retains sufficient earnings to reinvest in growth while providing consistent dividends. Ratios above 75% can signal that the company is overextending itself to pay dividends, leaving little room to maneuver during economic downturns. On the other hand, a payout ratio below 30% might indicate that the company is prioritizing growth over rewarding shareholders, which may not align with the objectives of income-focused investors. Sustainability alone is not enough for a dividend-paying company to qualify as a good investment. Dividend growth is equally important. Companies that consistently increase their dividends signal strong financial health and a commitment to rewarding shareholders. The compound annual growth rate of dividends over a 5 or 10-year period is a useful metric for assessing whether a company's dividend growth is steady and reliable. Dividend aristocrats and dividend kings, companies that have raised their dividends for at least 25 and 50 consecutive years respectively, are often viewed as gold standards in dividend investing. These companies demonstrate resilience, financial discipline, and the ability to adapt to changing market conditions while prioritizing shareholder returns. The sustainability of a company's dividend payments depends largely on its financial health. Investors should evaluate a range of financial metrics metrics and indicators to ensure that the company is capable of maintaining and growing its dividends over time. Earnings stability is a cornerstone of dividend sustainability. Companies with consistent or growing earnings are better equipped to maintain regular dividend payouts. Historical data on earnings per share growth can provide insights into a company's profitability and its ability to withstand economic challenges. Conversely, companies with volatile or declining earnings may struggle to sustain dividends. For example, during economic downturns or industry-specific crises, companies with unstable earnings often reduce or suspend their payouts, affecting investors' income stream. Excessive debt can threaten a company's financial stability and its ability to pay dividends. The debt-to-equity ratio is a useful measure for assessing leverage. Companies with manageable debt levels are more likely to prioritize dividend payments during challenging periods. In contrast, heavily indebted companies may be forced to cut dividends to service their debt. Return on equity measures a company's efficiency in generating profits from shareholder investments. A high and consistent ROE is a sign of effective management and a robust business model, making the company a more reliable choice for dividend investors. The industry in which a company operates plays a significant role in its dividend-paying ability. Some industries are naturally more conducive to paying consistent dividends due to their business models and market dynamics. Defensive sectors, such as utilities, consumer staples, and healthcare, are known for their stability and resilience to economic cycles. Companies in these sectors often generate predictable cash flows, enabling them to maintain regular dividend payments even during recessions. For example, utility companies benefit from steady demand for electricity and water, while consumer staples companies provide essential goods that remain in demand regardless of economic conditions. Cyclical sectors, such as energy and industrials, may offer high dividend yields but are often more volatile. Dividend payouts in these sectors can fluctuate based on market conditions, such as changes in commodity prices or economic demand. Growth-oriented sectors like technology typically prioritize reinvestment over dividends, though mature companies in these industries, such as Microsoft or Apple, may still offer attractive dividend growth opportunities. To reduce risk, investors should diversify their dividend portfolios across multiple sectors and industries. This approach ensures that income streams are not overly dependent on the performance of a single sector, providing stability during economic downturns or industry-specific challenges. The quality of a company's management team and its corporate governance practices are critical factors in dividend investing. Transparent and shareholder-friendly management is more likely to prioritize consistent and sustainable dividend payments. Investors should review the company's communication with shareholders, such as earnings reports, dividend announcements, and management commentary, to assess its commitment to rewarding investors. Additionally, companies with a history of prudent financial management are better equipped to navigate economic uncertainty and maintain dividends. Look for evidence of sound capital allocation practices, including balanced reinvestment, debt management, and shareholder returns. Dividend investing, while rewarding, is not without risk. Investors should be cautious of certain pitfalls. High yields can be tempting, but they often indicate underlying financial distress or unsustainable payout policies. It is better to focus on moderate yields that are supported by strong fundamentals. A company's dividend history is important, but it is not sufficient on its own. Assessing financial health, industry positioning, and management quality is essential for making informed decisions. Concentrating investments in a single sector or region increases vulnerability to market fluctuations. Diversifying across industries and geographies reduces risk and ensures income stability. Selecting the right dividend-paying company is a nuanced process that requires careful analysis of financial metrics, growth potential, industry positioning, and management quality. By focusing on sustainable yields, consistent dividend growth, and strong financial health, investors can identify companies that provide reliable income and long-term value. Avoiding common pitfalls, such as chasing unsustainable yields or failing to diversify, ensures a balanced and resilient portfolio. Dividend investing offers a powerful strategy for achieving financial independence, but success depends on a disciplined and informed approach. When executed thoughtfully, dividend investing can provide not only a steady income stream, but also the potential for wealth creation over time. Hopefully this video gets you on the right path to making your own investment portfolio and pick stocks that have everything you need for long-term performance. Thank you for watching. Like and subscribe. Remember, dividends can make you money forever.